A warm welcome to the Risk Reversal podcast. Guy Adami moraying a bit if you're watching this on YouTube. That, of course, is Elizabeth Thomas. She is not moraying because she's wearing a solid color. It looks like a drab olive. Is that fair?
Did you call it drab?
Drab?
Oh, drab. Yeah, it's an olive green. Yeah, I'm following my PR media training. Solid color.
Solid colors are
No patterns.
because you can see my shirt. If you're looking closely, it's doing all kinds of funny things. It's not in real life, but it does it with the camera. Anyway, we're not here to talk about that. We are here to talk about a few things. I'll start with this. The Packers of Green Bay yet again proving their dominance in the NFL. Aaron Rodgers had an opportunity to do something Sunday evening that no quarterback had ever done before. Do you know what that is? No, you don't.
No,
I could see
I
the
don't.
quizzical look on your face. I will answer it for you. I'm not going to make you sort of pine for this. He had an
Okay.
opportunity Sunday evening to beat every team in the National Football League. Obviously, he played for the Packers of Green Bay for quite a long time. And then Sunday night, as a member of the Pittsburgh Steelers, he had an opportunity to beat that team, but he did not. So he has defeated 31 of the 32 teams. I know that's not particularly interesting, but there you go.
I find it very interesting. I am not heartbroken about his inability to do so.
No, I think a lot of Packers share that feeling. What you're also not heartbroken about is just the continued performance of the stock market. Now, Friday we had a CPI report that, I think for a lot of people was sort of a benign. I mean, I looked at it and there was not a lot to glean from that. The market obviously liked it because you saw what the reaction was, but I didn't see. Let's put it this way: I didn't think it was particularly hot, but I didn't think it was particularly cool either.
Yeah, it was flat-ish, right? Technically, it was below expectations. Here's the thing. I've said this before. Expectations matter much more than the event itself. And going into that CPI print, people were expecting something a bit warm, not hot, but warm. So I think we were prepping ourselves for maybe a print that was going to come in slightly above expectations. That's not what happened. But since expectations were for it to be warmer, we celebrated in Jubilee because it came in cooler than expected. So it was a non-event. It was about as non-event gets. And I think that that's okay, especially during a period when, number one, we're more concerned about labor data anyway. But in the absence of all data, we were getting this one data point. If that had really swung things in one direction or another, all it would have done, in my opinion, is set us up to swing right back once we started to get more clarity on everything else that might be going on. So this sort of non-event, it was forced out because it needed to happen in order to get Social Security payments calibrated the proper way. It was deemed a necessary data point. That's why it was reported. It wasn't reported because the Fed needed it. It was reported for Social Security. So now we've got this Fed meeting coming, and that's really what everybody is waiting for.
All right. On the back of that, you saw a bond market, which quite frankly didn't really react either to the upside or the downside. As we're sitting here, 10-year yields are probably unchanged from where we were last week. So that was a non-event. But something did happen last week in addition to the equity market, and that's we saw the first significant downdraft in the gold market. And I don't really know what sort of precipitated it. I just think it was there was an inevitability to it in terms of the overbought conditions that we found ourselves in. You and I actually talked about it, I think, a while ago, and it's coming to fruition. And I want to be crystal clear. I don't think, nor do you think, I'm putting words in your mouth, that this gold move is over. But I think this 10%-ish correction in the underlying commodity was probably much needed. And I think it gives us a place to sort of hit the refresh button and start the next move higher in the weeks to come. So thoughts on that?
So we had talked about this ad nauseum, but in the last couple weeks talked about the fact that it was technically extended, meaning every technician on the street, and rightfully so, was saying it is so far overbought, right? It's above the 200-day moving average. It got up to like almost 50% above the 200-day moving average, and it needed to have a little bit of a breather. It didn't make any technical sense about why the chart would continue going up. So I agree, this probably was inevitable at some point. It did happen sooner than I expected. I thought it would continue running for a while. I actually thought the next stop would be 5,000 before people would really start to freak out. And the other thing that we had talked about, I said this, so definitely guilty as charged. I was like, well, even if it does go down, who's selling, right? Central banks aren't selling. So it's got to be retail then that's going to drive it back down, because it's not as if suddenly all these central banks are going to unload their reserves because gold itself is technically extended. They're not in it for a trade, they're in it for reserves. So clearly retail had a little bit more of a hand in this. Maybe it's institutions that started to make that big move happen. And that day it was down 6-ish%, 6 and change, I believe, if you're looking at gold, the commodity price itself. So I think what happened was some of the selling began, and then you've got the algorithms that kick in, and the selling begets more selling. So
Yep.
the move, even today, we're recording this on Monday. I believe it comes out on Tuesday, but the move today down, but not nearly as bad, only down about 2.5% at this point.
Yeah, and I think, I talked about this with Dan earlier, but this is what I think is going to happen. There'll be a day where we open lower and then reverse close higher. And again, I don't know from what level that will be, but I actually think we're getting pretty close to that. And that will be, to me, the next leg higher. So we'll see. But your point is well taken. This is not central banks unloading their gold in any way, shape, or form. I just think, and this is going to sound somewhat glib, I don't mean it to, but in the absence of buying, and when you have potentially some sort of sell program that's put in place, you hit these air pockets, and I think that's what gold saw. But it also, to me, this was a much needed move. With that said,
Well, hold on. I just one other thing. The reasons that I think people are buying have not changed. So
no.
that's why what you said earlier, I don't think this move is over. I don't know where the pause and the refresh happens. I feel like maybe it could go a little further than this down before that next leg actually finds itself. But the reasons that people have bought have not changed. We still have very little confidence in fiscal austerity around the globe. We have not fixed what central banks are afraid of and why they've shifted their reserves into gold. We are worried about national debt here, obviously, and we've got, other replacements for the dollar. The dollar has found a little bit of upside, but it hasn't come back to the strength to replace gold. So there's a lot of reasons out there that still remain the problem.
Yeah, I'm with you, and I'll wait for that day. But I do think we're a lot closer than people realize, because again, the fundamental reasons are still in place. Some of the other things that have been going on, obviously, we have a Fed meeting this week. It's a foregone conclusion. Dan and I actually talked to Stuart Sopp. Stuart, as you know, is the co-founder of Current, and he actually posited that he thought there was a 50-50 chance that they cut by 50 basis points this week. I do not think that's going to happen. I don't think you believe that's going to happen. Although I'll tell you, the market sort of seemingly is trading like it's going to happen, but here we are. So I think again, 25 basis points is in the cards. We skip November and then we'll come back in December. We'll see where we are in December. But in terms of the importance of this Fed meeting, unless they do 50, which again I don't think is going to happen. Again, I think this is pretty much run-of-the-mill foregone conclusion unless something comes out of the presser.
I don't think they're going to do 50. However, you asked me before we started recording if there was anything burning on my mind, and I said, no, just the regular stuff that's going on this week. I changed my mind.
Change your mind. You're entitled to do that.
Changed my mind because I forgot about this. So I don't think they're going to cut rates by 50, but they could do something that would effectively be 50, that would effectively look to the market as if it had gotten more dovish. And that is if they announce the end of QT, which is looking increasingly likely at this meeting. I'm not going to get into all of the intricacies of why that is, but long story short, we had QT, quantitative tightening, that's been going on for a while now. They've been running off about 15 billion of mortgages, 5 billion of treasuries each month. And the Fed had originally talked about maybe ending that program towards the end of 2025. Well, the expectation has now become that maybe they have to pull it forward because the liquidity picture has changed. And as they continue engaging in QT, they are tightening that liquidity. So they don't have as much of a buffer anymore to keep going. The biggest part of that being the fact that the repo facility is now drained. The repo facility had been making up for what was happening in QT. Now bank reserves are what would have to absorb QT if they continued it. And they do not want that to be the case because bank reserves have now fallen to what is called ample territory. They used to be in abundant territory. Now they're ample. So what we could hear at this meeting is 25 basis points and an end to QT, which would effectively be closer to 50 basis points.
Now, they have hinted at this, as you pointed out. And again, think the market is sort of anticipating year end in the next year. This would be the market would enjoy this a great deal, but
Yes.
the reasons why I think at some point need to be examined, and you just sort of talked about it. I mean, the ample liquidity. I don't know what's after ample in terms of the next rung lower, but that's something that we people, some of the wonks out there have been pointing out the repo facility and how the well is seemingly running dry. You can look at it one of two ways. There's something going on, or that there's a tacit acknowledgement by the Federal Reserve, and it's, nothing bad has happened. All things are good. And if they're going to end this program sooner rather than later, that's all very positive. Thoughts on that?
Yeah, I think right now it's in a place where reserves are in an okay place. Ample is fine. Ample is just like the porridge in Goldilocks and the Three Bears,
I'll
right?
stop for a second.
It's
It's
not.
funny you mentioned porridge. Somehow that came up on the show One Night Fast Money years ago, and I said something like, "Does anybody actually eat porridge?"
I
In a
don't even know what
somewhat
porridge is.
derogatory fashion. And the mail that I got in response to that, it's like, oh my God, like the National Porridge Association or something, the NPA came after me.
I do.
Anyway,
What is it? Is it like I've
it's
always
like
thought, is it
it's
like a
like
mix between oatmeal and grits or what?
I think it's some sort of like, I mean, I should be careful here because of the porridge people, but it feels like just sort of some amalgam of those things, like sort of like a slop type of
Maybe
thing. Anyway,
cream
back
of
to
wheat?
you.
Cream
Ugh,
of wheat, perhaps.
farina.
Okay. Anyway,
Do you know this farina? I don't know if you know this or not. Anyway.
spirina or farina?
Or farina. We'll put
Farina.
it in the show notes, but that's like a porridgey type of thing. Anyway,
Isn't
sorry.
it the stuff they put on the bottom of a pizza so it doesn't stick?
No, I think that's cornmeal.
Oh. Well, it's a good thing
Really?
that we don't work in a restaurant.
Yeah, okay, damn
Uh,
good.
anyway, ample reserves are just right. Not too hot, not too cold. That's where you want them to be. So the Fed would prefer that they stay there. The problem is if they keep going in this QT program and the reserves have to soak up what they are rolling off, then we go down from ample to scarce, and that's not a place that we want to be. So they would like it to stay where it is. I think this is a manageable place, and they're happy with what's in the Treasury General account. It's okay that the repo facility is drained because everything is more in balance now. But anyway, it's precarious in the sense that they can actually affect it. So they don't want to go too far. They've made that mistake before, and they don't want to do that this time. So I would expect an end to QT to be announced on Wednesday. I do think the market will like that. I do think that the market will view that as extra dovish, that they're using other tools to send a dovish message rather than just messing with rates, which I think is okay, kind of placating the market, especially those that really want more rate cuts. So we can placate in the meantime with the end of QT. And then, as you mentioned, we pause in November, no meeting. And then December, at this point, the market believes we'll get another 25 basis points. And the next year is when, if the administration gets what they want and they stack the Fed they want to, the way that they want to, next year is when the real dovish part probably kicks in.
Fair enough. And and we'll obviously talk about that, but as you know, the market loves to challenge new Fed chair. So we'll see what the market does in response. We also have a slew of earnings, not least of which your firm SoFi reports. You don't have to opine there. I just mentioned it, but Microsoft, Apple, Amazon, we got a big week in terms of earnings. We also have, on top of Fed, on top of earnings, we have President Trump sitting down with President Xi of China. Over the weekend, Treasury Secretary Bessent said that basically the outline for a plan is in place, and the market obviously, I think in terms of futures last night, liked that a great deal, and here we are. So in terms of the importance, I mean, those three things, Fed earnings, U.S. China talks. I mean, it's probably right down the middle, a third in terms of the importance of the market. So I don't think you're expecting necessarily anything negative to come out of that, but could you see something incrementally positive in that meeting on Thursday?
I think you could see. Well, what would be surprising to everyone, I think, is if it was signed, sealed, delivered, we had a
Right.
deal this week. I don't think anybody's expecting that. So if we get closer to a deal than we're expecting, then I think that's very positive for the markets, both Chinese markets and US markets. I think everybody would be relieved about that and the overhang could be removed a bit. But I mean, even just rewind 2 weeks, right? That Friday, that was that 2 Fridays ago, where the announcement came out that we were going to put more tariffs on because of the rare earth stuff. And then it was a misunderstanding and all the hullabaloo that surrounded it. But the market was really upset about that, at least on Friday. So I think removing some of that consternation will be a positive regardless. And the fact that they're even meeting, because at that point, I think Trump said, we're not even going to have this meeting. So anyway, now that they're meeting, I think that's a positive as well.
Agreed.
So watch for that. I think we're headed in the right direction. As far as earnings go, we've got a lot of the Mag 7 reporting this week, and the big question is, how important are they? They're very important, especially for Q3 earnings. When you look at the expectations for the S&P 500, technology is still supposed to take the top spot in EPS growth. Surprisingly, financials is taking the number 2 spot as far as expectations are right now, and comm services isn't until, let's see, 1, 2, 3, 4, 5, 6, number 6 spot. So the companies that fall into the tech sector are important for these earnings expectations on an index level to stay where they are. You asked if there could be any positive surprises. I know you were talking about China, US, but positive surprises from an earnings perspective would be if the companies that fall in comm services in the Mag 7 do come in above expectations as well. So that could bring things up higher than we're expecting on a broad index level. But this is a very important week, always a very important week when the Mag 7 reports. I know we'd like to believe that it's about the other 493, but reality is we're still going to hinge on what the Mag 7 says.
And obviously then the importance of this week can't be understated as we head into November, but I'll say this as well. The volatility index, which was clearly a thing for the last couple of weeks, is no longer a thing on a week where we have all these different events, I'm using air quotes. So are you surprised? I will tell you I am, but by the VIX being, with a 16 handle again, given what we saw, given those couple spikes we saw over the last couple of weeks?
No, I'm not. I would be surprised if we had a 12 handle again.
Mm-hmm.
But I guess the 16 handle, I'm not as surprised about. What we've been talking about when the VIX was so subdued for a while, didn't even get down to like 10 for a little while there. But when it was so low, we had talked about 15 being normal, 20 being high. So the fact that we're above 15, I think is better. It's not entirely complacent. It's still low, but something that we have to remember about the VIX that more so even now than ever before, when we have a spike in the VIX, it is so short-lived. It happens for maybe that one day, but even on that one day, it happens for maybe a couple hours. It doesn't stay there all that long. So I think these very quick spikes, and maybe that's the 0 days to expiration options that are affecting it, but these very quick spikes correct themselves pretty quickly unless there's some sort of major thing going on. And the fact is we just haven't had a major thing. Also, something else to point out from a technical perspective, we are, and this is something that Chris Verone from Strategas points out, we are right in the spot where Q4 momentum and seasonality starts to really have an effect on the positive side. Something like the 20th trading day of October is when it usually starts to kick in. So if technicals, if seasonality holds true this year, we're sort of off to the races through December 31st.
Well, it certainly feels that way. I mean, the chase is clearly on, and I think with each passing day and with fewer and fewer days left in the year, people that are behind the curve for whatever reason are going to start to chase, and they're not going to chase in the S&P. They're going to chase in names where they think they can make up ground, which is, I think, one of the reasons a lot of the things that you and I have talked about over the last couple of weeks is starting to come to fruition. A lot of these names with not necessarily strong fundamentals, but there's some pretty high beta. They've all been moving. And then obviously names where you think you can get a bang for your buck. I mean, people are there as well. It's hard to, again, on October 27th, this is today when we're talking about this, it's hard to envision a situation where you don't see this melt up. But that's one of the problems that's struggling with, because it's when you can't see it is typically when it happens.
Yeah, that's absolutely right. But the other thing is, we talked about this last week on Market Call. There are some names out there that I know you really like that do have the fundamental strength that haven't kept up. I'm thinking about some names in the energy space, for example. I obviously talk about sectors. Energy is one of those that I've gone back and forth on. The sector that I've been pounding the table on that hasn't kept up is healthcare. I still really believe in that. And I do believe that there's going to be upside potential through the end of this year and into next year, especially because of midterm elections and the way that the stock market typically has a volatile period during midterm election years. But I think there are also fundamental fundamentally strong options out there that can see upside in this environment. Also small caps when they need to do this catch-up trade. And I think they can get back on that horse if we have a bullish move into year end.
Yeah, I'm with you on the energy names, and I'll leave today's podcast with this. I think in terms of some of the oil service names, Halliburton, formerly Schlumberger, now SLB Corp, both of those are starting breaking downtrends that have been in place for about a year and a half or so, and both seem to be making, as Carter Worth would say, a bearish to bullish reversal. And you're actually starting to see some signs of life in the big cap integrated names, and some of the refiners and the downstream plays like Valero and Marathon Petroleum, they're doing well as well. I think the next leg for those stocks, in my opinion, will be a rotation on the back of whatever. I mean, it could be out of tech, but some sort of rotation we will see. But here we are, Elizabeth. We continue to sort of, a lot of the things that have been going on, with the exception of a day here and there, are just a continuation of this theme that we've had in place for quite some time. So we'll see if this week changes the narrative at all.
I expect that it may not.
She's Elizabeth Thomas. I'm G Swizzle. Liz will be with us on Market Call this week. Her and Mario's work continues to be outstanding. Folks, we'll see you soon.